Welcome back to Cashegories, where we break down the latest financial news, provide insights, and help you navigate the complex world of finance. Today, we're diving deep into a significant event that has rocked the global financial markets. The sharp decline in the Japanese stock market that wiped out a staggering $1.1 trillion in just a few days. This represents a substantial portion of Japan's $6 trillion market, leaving investors around the world wondering, what caused this dramatic drop? What are the broader implications for the global economy, and what can we expect going forward? In this episode, we'll explore the multifaceted factors behind this decline, analyze the impact on various sectors, and consider the potential long-term effects on both the Japanese and global economies. So grab a cup of coffee, settle in, and let's dive into this unfolding financial drama. To set the stage, let's start by looking at the numbers. At the beginning of August, Japan's stock market saw an unprecedented drop, losing $1.1 trillion in market capitalization. To put this in perspective, that's nearly 20% of the entire market value, gone in the blink of an eye. The Nikkei 225, Japan's premier stock index, plunged, dragging down the entire market with it. The scale of this drop cannot be understated. Japan's stock market is the third largest in the world, after the United States and China, making this event not just a local issue, but a global one. Investors, both domestic and international, are now grappling with the consequences of this sudden and severe downturn. But what triggered this dramatic sell-off? One of the key factors behind this market decline is the strengthening of the Japanese yen. Over the past year, the yen has appreciated significantly against the US dollar, reversing a trend of weakness that had previously been a boon for Japanese exporters. As the yen strengthens, Japanese goods become more expensive on the global market, which can lead to a reduction in export volumes, a critical concern for an economy as export-dependent as Japan's. But why has the yen strengthened? A combination of global economic factors, including the relative weakness of the US dollar due to shifting monetary policies, and a perception of the yen as a safe haven currency amid global uncertainties, has driven up demand for the yen. This has been exacerbated by the Bank of Japan's cautious approach to monetary tightening, which contrasts with the more aggressive rate hikes seen in the US and Europe. Another significant factor is the global inflationary environment. Inflation has been a persistent issue across major economies, including Japan. Although Japan has traditionally struggled with low inflation and even deflation, the recent global surge in prices has caught up with the country. Rising costs of raw materials, energy, and other inputs have squeezed profit margins for Japanese companies, particularly in manufacturing and technology sectors. The Bank of Japan has been under pressure to respond to these inflationary pressures. However, the central bank has historically maintained a very loose monetary policy, including negative interest rates, to stimulate economic growth. Now, with inflationary pressures mounting, the Bank of Japan faces a dilemma: raise interest rates to combat inflation, which could stifle economic growth, or maintain its current stance and risk runaway inflation. This uncertainty has contributed to a loss of confidence among investors, leading to the massive sell-off we've seen. The potential for higher interest rates has also led to concerns about increased borrowing costs for both businesses and consumers, which could further slow economic activity and hurt corporate earnings. Let's dive deeper into the interest rate dynamics. For decades, the Bank of Japan has been an outlier among central banks, maintaining ultra-low and even negative interest rates in an effort to combat deflation and stimulate economic growth. This policy has been a cornerstone of Japan's economic strategy, providing cheap capital to businesses and encouraging spending and investment. However, the global economic environment has changed. With inflation on the rise globally, central banks in the US, Europe, and other regions have been aggressively raising interest rates to cool down their economies. While the Bank of Japan has been slower to act, the mere hint of a policy shift towards tightening has been enough to unsettle markets. If the Bank of Japan decides to raise interest rates, even slightly, it could have significant consequences. Higher interest rates would increase the cost of borrowing, which could lead to a slowdown in investment and consumer spending. For companies already struggling with thin profit margins due to rising costs, this could be the straw that breaks the camel's back. Moreover, higher interest rates could lead to a stronger yen, exacerbating the challenges faced by exporters. The combination of these factors has created a perfect storm of uncertainty, which has led to the sharp decline in the stock market. The impact of the market decline has been felt most acutely in key sectors like automotive and electronics, industries that are not only vital to Japan's economy, but also global leaders in their fields. Let's start with the automotive sector, which includes giants like Toyota, Honda, and Nissan. The automotive industry has been under pressure from multiple fronts. Supply chain disruptions, which began during the pandemic, have continued to plague the industry, leading to shortages of key components like semiconductors. These shortages have forced many manufacturers to cut production, leading to lower revenues and profits. Additionally, the rise of electric vehicles, EVs, has created new competitive pressures. Japanese automakers, traditionally strong in internal combustion engine technology, are racing to catch up with global competitors in the EV space. This transition requires significant investment, which is challenging in an environment of rising costs and declining profits. The electronics sector, another cornerstone of Japan's economy, has also been hit hard. Companies like Sony, Panasonic, and Sharp have faced similar challenges with supply chain disruptions, rising input costs, and shifting consumer demand. The strong yen has added to these challenges by making their products more expensive in international markets, leading to lower sales and profits. The impact of Japan's market decline extends far beyond its borders. As the third largest economy in the world, Japan plays a crucial role in global trade and finance. A significant downturn in Japan can have ripple effects across global markets, particularly in Asia, where many economies are closely tied to Japan through trade and investment. For example, Japan is a major trading partner for countries like China, South Korea, and Taiwan. A slowdown in Japan's economy could lead to reduced demand for imports from these countries, which could in turn slow down their economies. Additionally, Japanese companies have significant investments and operations in many other countries, meaning that a decline in their financial health could impact employment and economic activity abroad. The sell-off in Japanese stocks has also contributed to increased volatility in global financial markets. Investors around the world are reassessing their portfolios, leading to fluctuations in asset prices across different regions. This could lead to a broader reassessment of risk, particularly in emerging markets that are more vulnerable to shifts in global capital flows. Furthermore, the decline in Japan's market has implications for global investors, including pension funds and other institutional investors that have significant holdings in Japanese assets. A prolonged downturn could lead to losses for these investors, which could have knock-on effects on financial markets worldwide. One of the less tangible but incredibly important factors in this market decline is investor sentiment. Financial markets are not just driven by economic fundamentals, they are also influenced by the emotions and perceptions of investors. When fear and uncertainty take hold, they can lead to a self-fulfilling prophecy where selling begets more selling, leading to a downward spiral. In the case of Japan, the combination of economic uncertainty, rising costs, and potential policy shifts has created a climate of fear among investors. As they rushed to sell off their holdings, the market decline accelerated, creating a feedback loop that has been difficult to break. This is a classic example of market psychology at work. In times of uncertainty, investors often focus on the short term, reacting to daily news and market movements, rather than taking a longer-term perspective. This can lead to panic selling, where investors liquidate their positions at a loss, only to regret it later when the market eventually recovers. Understanding market psychology is crucial for investors who want to navigate turbulent times. While it's natural to feel anxious during a market downturn, it's important to stay focused on the long-term trends and avoid making hasty decisions based on fear. To put the current situation in context, let's take a look back at Japan's economic history. Japan has experienced significant market turbulence before, most notably during the 1990s when the Japanese asset price bubble burst. This period, known as the Lost Decade, was marked by stagnant economic growth, deflation, and a prolonged period of financial malaise. During the 1980s, Japan experienced rapid economic growth, driven by a combination of industrial expansion, real estate speculation, and stock market exuberance. However, this boom came to an abrupt end in the early 1990s when the asset price bubble burst. Real estate and stock prices plummeted, leading to widespread financial distress among banks, companies, and households. The lessons from the lost decade are still fresh in the minds of Japanese policymakers and investors. While the current market decline is not as severe as the bubble burst of the 1990s, it does raise concerns about the potential for another prolonged period of economic stagnation. However, there are important differences between then and now. Japan's economy today is more diversified, with a stronger focus on innovation and technology. Additionally, the global economy is more interconnected, which means that Japan's fortunes are closely tied to developments in other major economies. Despite the challenges, there are reasons to be cautiously optimistic about Japan's long-term prospects. Japan remains one of the most technologically advanced and globally integrated economies in the world. Its companies are leaders in fields such as robotics, electronics, and automotive technology, and the country continues to be a major player in global trade. One of the key strengths of Japan's economy is its capacity for innovation. Japanese companies are at the forefront of developing new technologies, from advanced robotics to renewable energy solutions. This innovation-driven growth could help Japan overcome some of the structural challenges it faces, such as an aging population and declining workforce. Furthermore, Japan has a strong institutional framework, with well-established legal and regulatory systems that provide a stable environment for business and investment. The Bank of Japan, despite the challenges it faces, has a track record of taking decisive action to stabilize the economy in times of crisis. If the current market downturn continues, it's likely that we will see further interventions from both the central bank and the government to support the economy. In addition, Japan's geographic location and economic ties with other major economies, particularly in Asia, position it well to benefit from regional growth. As Asia continues to be one of the fastest-growing regions in the world, Japan's deep integration with these markets could provide a buffer against global economic shocks. For investors, the key question is how to navigate this volatile market environment. The first and most important strategy is to avoid panic selling. While it's natural to feel anxious during a market downturn, history has shown that selling in a panic often locks in losses and misses the opportunity for recovery. Markets are inherently cyclical, and downturns are a normal part of the investment landscape. One of the best ways to manage risk in a volatile market is through diversification. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce their exposure to any single market downturn. This approach can help mitigate the impact of market volatility and provide more stable returns over the long term. Another important strategy is to focus on the long term. Short-term market movements can be unpredictable and are often driven by factors that have little to do with the underlying fundamentals of the economy. By maintaining a long-term perspective and sticking to a well-thought-out investment plan, investors can ride out market volatility and position themselves for future growth. Additionally, investors should consider their individual risk tolerance and financial goals. For those with a lower risk tolerance, it may be wise to reduce exposure to equities and increase allocations to more conservative investments like bonds or cash. For those with a higher risk tolerance and a longer time horizon, market downturns can present opportunities to buy high-quality assets at lower prices. Looking ahead, the future of Japan's market remains uncertain, but there are several possible scenarios. If the global economic environment stabilizes and inflationary pressures ease, we could see a recovery in the Japanese stock market as confidence returns and investors seek opportunities in undervalued assets. However, if global economic conditions worsen, or if Japan faces additional domestic challenges, the market could remain volatile for an extended period. One of the key factors to watch will be the Bank of Japan's response to the current economic situation. If the central bank decides to raise interest rates, it could lead to further market adjustments, but it could also provide long-term stability by keeping inflation in check. On the other hand, if the Bank of Japan maintains its current policy stance, we may see continued uncertainty as investors weigh the risks of inflation against the benefits of economic growth. Investors should also keep an eye on key economic indicators such as GDP growth, inflation rates, and corporate earnings. These indicators will provide important clues about the direction of the economy and the stock market. In particular, corporate earnings reports will be crucial in assessing how companies are managing the current challenges and what their prospects are for the future. Overall, while the short-term outlook may be uncertain, Japan's long-term economic fundamentals remain strong. By staying informed and maintaining a disciplined investment approach, investors can navigate the current market environment and position themselves for future success. The $1.1 trillion drop in Japan's stock market is a stark reminder of the complexities and risks inherent in global financial markets. While the immediate future may be uncertain, it's important to keep a long-term view and remember that markets tend to recover over time. Japan's economy, while facing challenges, remains resilient and well-positioned for future growth. Thank you for tuning in to Cashegories. Stay informed, stay rational, and as always, stay invested. Don't forget to like, subscribe, and hit the notification bell to stay updated on all things finance. See you next time.